This should be a lot of fun. This is how to sell a business, a step-by-step guide. This is part one of two parts. We'll have part two next week at same time, 10 a.m. Central Time on 5/15. My name is Tom Goldblatt, Managing Partner of Ravinia Capital, and we are joined by our panelists, Phil Buffington, a partner at Balch and Bingham, Jonathan Friedland, partner of Mush and Chellis, Richard Claywell, he's the owner of Richard Claywell CPA, a valuation firm, Gregory Laffin, Managing Director of Whipley. Next week, we'll be joined as well with Brad Pickard of Republic Partners. This is brought to you by Financial Poise, put together by Financial Poise. And we have certain sponsors that have helped make this possible. Mood, the nation's premier online retail cannabis dispensary. Information's on slide 3. As well as two other sponsors, Type to Learn, a Sunburst digital company, as well as Max Assets, which is conduct an online auction and turnkey solution. The last thing we begin is going to have a disclaimer, and I'm going to read this. The material in this webinar is for informational purposes only. It should not be considered legal, financial, or other professional advice. You should consult with an attorney or another appropriate professional to determine what may be best for the needs of your specific situation. While the webinar producers and speakers take reasonable steps to ensure that the information presented is accurate, they make no guarantee in this or that regard. Let me just tell also that about the slides, I'll try to call your attention to slides that are relevant to whatever we are talking about, so you can take notes if you like, but don't worry if you're listening but not watching the webinar. You'll be just fine because the slides are not critical. Having said that, I'm going to kick it off myself with the first slide is why are reasons for people wanting to sell a business? And they quite vary on the different situation. There's all sorts of companies, whether they're privately held, a public corporation, or a private equity firm. But generally, they want to cash out, to have a succession plan. They might be in a distress situation and they need additional capital, or they might want to grow the company and they're seeking capital from a private equity or other to help them assist with their growth and take it further. Having said that, I'm going to turn over our first question to one of our panelists, Phil, who's going to cover slides 12 to 16. What are the first steps a business owner should take when they decide to sell their business?
Well, Tom, I thank you for the introduction. And I think you've already touched on the first step that I would mention, and that is identifying the reasons for selling. Because if you know that, then you know the direction you need to go. Some of the things I would suggest is make sure you're prepared to sell the business, and I'll touch on that a little bit in a minute. And then organize the process to make sure that you are going through it logically, and then have a plan that you intend to follow and manage that plan. But some of the things in particular I would recommend are, prepare the business for sale. Make sure that the records and documentation are in order. So when people are doing their due diligence, they know that you've run an orderly business and the documents and records exhibit that. Determining whether or not you want to hire an appraiser and whether or not you want to hire business brokers. You've got to take those steps, which I think are really important. You've got to consider how you're going to communicate with your potential buyers, either through a data room or some other mechanism, which you need to have in place. I mentioned holding management meetings, which I think are important. Depending on the size of the business, the larger the business, I think the more important it is to have those management meetings, because the management of the company may be dispersed throughout different divisions. Some of the things you need to really look at again is determining that you have complied with all the laws and regulations and you have a proper license. Make sure you've paid your taxes. And two big things that I would say you always look at is whether or not there's deferred maintenance in your business, and whether or not you need to take steps to really carry out some of that deferred maintenance beforehand, or if you need to be prepared to deal with those issues as the buyers come forward. And the last that I'll just touch on briefly is if there's any pending litigation or anticipated litigation, be prepared to discuss that as the due diligence process goes through.
Bill, that's an outstanding answer. I'm going to ask the next question to Richard. And what financial records and metrics should business owners focus on improving to make their business more attractive to potential buyers?
One of the issues that we've got is if you decide you're going to sell today and you haven't prepared, and I think Phil has alluded to this, you're not ready to go. So you want to look at your financial statements that you have. What's your income statements? What do they look like? And not just today, but what is the history of those financial statements? What is the history of the balance sheets that you have? Are you being profitable or are you not being profitable? And again, if you're marginal or you're not doing well at all, as an investor, I have the option to go to somebody else. So if you're not in good shape yet, may go with somebody else. You need to look at the risk that's involved. And then Phil mentioned some of these risks a while ago. There's a whole litany of risks. And he had mentioned litigation. You know, if you're involved in litigation, I know one of the problems I always have, and I ask the question, I always know what the answer is going to be. Per chance, if you were to lose a lawsuit, you know, how much damage have they caused to your company? And the lawyers always say, well, we don't know. And I understand that answer. But that is something that we need to address. We need to look at the different ratios that are out there that will tell us what the performance is. We can now take a look at those ratios and compare that to the industry to see how we are performing. Again, am I doing as good as the industry, better than the industry, or worse than the industry? And if you're doing worse or marginal, I'm probably going to go someplace else. We want to look at, from my perspective, we look at the return on investment. How much return am I getting off of the assets I have in the company? Then we have a return on assets ratio. There are, the last time I checked my analysis, we have 12 ratios that we look at to look at solvency. So again, if you're a marginal type of a company, today's the day to know that you've got some issues that you need to contend with. You've got to clean up the risks that are there. And you can't do that. Today is what, Wednesday? You can't do that by Friday. So it's a fairly long-term sort of thing. You need to take a look at these types of items. You need to talk to someone that has experience in dealing with the risks of the company itself, and manage those risks. Identify what they are. Everybody's got skeletons in their closet. You know, you need to look deep in that closet, find those skeletons, let's get rid of them, and then you're ready to sell. And that may be a year,
Well,
2 years, 3 years.
you can tell Richard and Phil, you both have a lot of experience with this. I'm going to kind of summarize just kind of what you're overall saying, because the value of a company, although when the price is set, it often seems like it's based off of the past and a multiple of the past performance. The fact is that companies are unique. They're not like bonds that like basically have 10 million EBITDA every year, and then you can discount that. There's risk involved whether that future cash flow will continue. So you guys are saying everything you want to do when you're trying to sell a company is eliminate some of that risk that's going to make that cash flow more unpredictable or unfavorable. So things like having lawsuits that aren't settled, they will blow up in a buyer's mind. If you have messy books and records, it's going to be hard for somebody to value. And if you're going to sell, they'll discount those. So everything is made towards, you know, making your company as predictable for a buyer to basically be able to take it over and know that their future cash flow stream will stay consistent or grow.
And Tom, to kind of complement that comment as well, I always say focus on the present and the trend, hopefully positive going forward. So historical information is great, but the buyers are very focused on what is today's backlog? How does that impact tomorrow? Because they are buying the company for tomorrow. So if you see a negative trend into the future, that also doesn't bode well for the business. So the best time when you're looking at you know, looking to sell your businesses when things are good, when things are clean, you have clean financial records, but you also have a positive trend that seems to continue into the future for that next future generation of ownership.
That's an excellent point, Greg. And one point to add too is that the buyer may be buying not the company as is, they may be blending it as a major trend in private equity acquisitions are more and more what called add-ons to a platform. So they might be really changing and buying for just a particular reason. So all this makes sense. I'm going to turn to Jonathan to ask, what are some legal pitfalls that business owners often overlook when preparing to sell their business, and how can these be addressed ahead of time?
Well, many owners overlook the importance of thorough documentation. Incomplete and inaccurate records can lead to best case delays, worst case, they can derail a sale completely. If possible, and unless we're talking about a situation of an unforeseen circumstance, a company can really start to get its house in order, not weeks, not even months, but a year or more in advance. And by doing that, a company can take its time to conduct a comprehensive review of all its documentation, its financial records, its contracts, its leases, its IP documents, and can work with counsel to button those things up, to update them, to make sure they're readily accessible. We already talked about unresolved legal issues, in the form of litigation and threats of litigation. And let's see, again, IP protection. Many business owners overlook the importance of protecting their IP. And again, these things can be addressed ahead of time. Employee arrangements and contractual arrangements, failure to address employee agreements. Do you have the right non-compete language that if you want it, that sort of thing, that if you wait until the time of sale and you realize a very, very important key employees are under no non-compete, they don't have the right confidentiality provisions, that could be a problem. The key assets that are bought when buying a business are the people who work at the business. That's off the top of my head.
That's an excellent. One other issue I see all the time with owner companies, and a lot of maybe people listening or their advisors, is key man issue. So you see the owner has really taken pride in his key role at the company, and he has a lot of the customer contacts, he signs all the checks, and he's really proud of that. What they don't realize a lot of times is that it becomes a negative. That creates risk for the buyer because they have no confidence that the present owner is going to want to work for them, even if they're all good intentions. So a lot of times, Jonathan, you were talking about starting years ahead. A lot of times, if you own a company and you want to sell it, but really the company's dependent on you, you'd be wise to start thinking about easing yourself out and bringing in a manager of the company that will be palatable to the buyers that will want to stay with it. Otherwise, you might be reducing your costs. So that's a ironic risk, is the key man being the owner themselves.
Owner-centric businesses, and it is a value detractor.
Yeah, exactly. Recently, not in my capacity as an attorney, but in my capacity as a business owner myself, I took a pass on a company when it became very clear that the owner, the term would be owner-centric. It was pretty clear that without the continued involvement of that owner and a really good transition period where the owner was willing to teach, for an extended period of time, he had kept so much control over the business, and he knew, all of the knowledge was in his head. That alone presented enough of a risk to just walk away from it.
I'm smiling because I think I introduced you into that opportunity. And
maybe.
Yeah, I'm gonna turn to Greg now, who's been chiming in with some really good points. But describe for us the two basic type of buyers.
Okay, yeah. So we have two key basic types of buyers. But for, those small business owners out there, I always say, three buyers too. So for the micro transactions, those under $5 million, typically you may sell to another owner operator through an SBA program or something like that. Most of the businesses we work with tend to be a little bit more established, and you're looking at, a strategic buyer, which tends to be more competitive. So you look at your competitors, they may not even be competitive, maybe because of where your geography is, or maybe you have a unique service or product offering that would be very synergistic or suitable for that company to sell to their current customers or client base. And then you have financial, and the larger the company, the more established they are, the more or less owner-centric they are, the deeper management bench and things of that nature, they can be considered a platform. And with the plethora of more private equity out there, a platform could be any company, as small as maybe 3 million of EBITDA on up. But the key is there a management team? Is it a business that is growing, that has a foundation that can grow more with the advent of capital, additional capital, and strategy through mergers and acquisitions? Private equity firms can also be strategic. And then we have that, under financial buyers, sometimes they're looking at add-on acquisitions. So they may have acquired a platform and they want to see that platform grow faster than it can otherwise organically, or enter new markets more competitively. And sometimes that means finding smaller add-ons and acquisitions to make them more attractive, more profitable. And it also is very accretive, usually into the platform, because typically the add-ons are smaller, so they're purchasing them at a smaller valuation or smaller multiple of earnings than they did the platform. So if they integrate it profitably into that platform, they receive a nice built-in valuation gain for the overall valuation of the company. But those are, traditionally the three type of buyers that we would see. We tend to focus a lot on the strategic buyers because there's a lot of organic growth nationwide, tends to be 3% or under. So for investors, especially in private equity with shorter term high range expectations or hold periods, 3 to 7 years common, they need to grow a lot faster than that 3%. And in order to do that, they complement that with acquisitions.
That's really great points, Greg. And I think there's kind of not black and white lines anymore. There's a lot of gray area between these. And so it is important to think traditionally a strategic is going to want to buy and hold and merge the companies together. And a financial buyer typically had a 5-year hold period looking for something like a 20% return in 5 years and exit. But nowadays, it's the hold periods are getting longer.
Yes.
The financials are often the strategics, and also there's a new group emerging of the family office buyer, which used to be limited partner investors in financial, but now want to hold themselves, and they tend to have longer hold periods as well.
Yeah, and when you look at who was the buyer for your business, you have to kind of go back to some of the previous discussions and kind of say, hey, if my business has some of these issues that we may have been talking about, and maybe it's a customer concentration or we don't have a deep management bench, we might be better suited as an add-on to a financial platform or an add-on to a strategic acquirer. And that's where our value will come to the owner in terms of best case scenario for business valuation.
I'm going to turn the next one to Phil. And what are some things that management can do to increase the value of a business as it prepares to approach outside buyers?
Well, the first thing I'd say, Tom, is give yourself plenty of time. Not plenty of time to prepare, as everybody has said, but also plenty of time to complete the transaction if time allows. A couple of things I'd like to point out. I know we talked about what kind of information do you get? How do you communicate to a buyer? I do think it's important to show the consistency of the past, where you've got a baseline of what the value of the business is. But as Greg equally said, I think it's entirely important for any seller to be able to show how bright the future is for their company, and basically explain why and have the data to support that reasoning behind it. Now, I know when we were talking about if you've got a single owner or a dominant owner, what do you do? I think what part of what you can do there is actually show where you've planned for succession. If you've got a good succession plan in place and you've got bench strength and you can show how the company's going to continue to run, you can offset that to some degree. Now, if you're a dominant owner, it's impossible to replace them, but you can offset it with a succession plan. Some of the other things would be, diversifying your revenue stream. If you're dependent on one or a few customers, in the planning process, diversify that revenue stream, where if somebody doesn't look at it and decides that my primary customer is Jonathan, and Jonathan may not want to deal with Greg after he buys my company. And so what do I do then? So if I've diversified my customer base, I can offset that to some degree. The other is look at ways to increase profitability, where your margins are, and be able to show what you've done along those lines. And then the other is really being able to set yourself apart from your competitors. If you are a specialty company, that's an easier task. But if you've got a lot of competitors out there, show how the new buyer is going to be able to continue the path that you've had in the past and be successful going into the future. You've really got to be able to showcase the real strengths of your company.
It's a great answer, Phil. I'm going to turn to Richard now and have him talk. Richard, if you don't mind talking a little bit about some common approaches to valuing a company at a reasonably high level, and maybe share with us when each is used.
Well, actually, there are three different approaches that you want to use or that are available to be used. I'll mention two of them, then we'll concentrate on the third. One is an asset approach. That's where you go out and figure out what all your assets are at fair market value. That's not real common. One that is fairly common is to use pricing multiples, and these are called relative values. If you could find companies that are comparable to yours and your performance is comparable to what they're doing, you might be able to use that as a methodology for determining the value. And Phil hit it right on the head a while ago. And Greg too. Well, everybody. We're looking at risk. What we've done in the past is fine, is good information, but will that continue into the future? I can't buy what's already been handled in the past. I can only acquire what's happening in the future. A lot of times we've got this phraseology that's called EBITDA. It's earnings before interest, taxes, depreciation, and amortization. It uses a pricing multiple to come up with the value. It's fairly common in M&A transactions.
Yep.
Look at the sales volume that people have. What's the trending on the sales volume? We can use discounted cash flow methods where we project into the future what we think is going to happen with either our earnings or our cash flow. And I don't remember who made the comment about it, but a lot of that deals with risk. I could be making $1 million a day.
Yeah.
But if my risk is so extreme that at the end of the day I only make $1, then it's not worthwhile. So we've got to get that risk and get that taken care of. And we may have intellectual property. Does that key into being able, for me to be able to generate more revenues than you can, because I've got some sort of patent that's out there or other intellectual property?
Yeah.
And Richard, for some companies, and you can kind of pick an industry like the construction services industry, they're very asset intensive. So sometimes that asset base or that asset value is a very key risk mitigator, because that's kind of the floor value of the company. They have all these assets that they can dispose of and liquidate if necessary, if things go bad. So sometimes you use a blend of these different value determinants. An asset value sometimes is like a minimum value or a floor value for some of the construction services sector, when looking at those industries.
I'd like to add from a practical point too on the value of a company is you can do all the valuation and you can see what companies in your industry kind of went for, but really every company is unique. And I find the buyers will value it based off of a street. What they see is their incremental cash flow discounted by the risk of achieving that. And then what are they going to pay for their company? They're going to pay as little as they can. So if you don't have a competitive process that's basically making sure that you're getting the people to bid up to what they really value the company at, they're going to kind of bring you down. So it's very important to have a process. I always say the company ends up selling $1 higher than the second highest bidder. So you can go in and think you know the values and stuff, but until you get, every time is unique. The M&A world right now, interest rates are higher than they were. Companies' valuations are changing. So valuations are good to get an idea, but you really aren't going to know until you have an effective process and that's and keep everybody to the close.
Well, and let me make a comment about that, because you all are 100% correct. In my world where I live, there are 3 different approaches, which is the asset, market, and income approach, but one size does not fit all. So you've got to look at this to see which of those methods do or do not apply, and what is the most appropriate. So part of that is what happens in the industry. We talked about construction a while ago. There's manufacturing, that's capital, it's equipment heavy. So there's just, it's not a simple answer. You got to look at a lot of different factors to figure out what's happening with a particular company.
Yep. I'm going to go to Jonathan on this next question. How have private equity and leverage lending funds affected business valuations and M&A valuation activity?
Well, I'm thinking. Stated real broadly, because PE firms have so much capital, powder, if you will, to deploy, it absolutely has led to increased competition for, attractive acquisition targets. And in turn, like all things in the economy and life, more competition, more buyers means the price goes up. Higher valuations for businesses, because PE firms are just willing to pay more. And there's a couple of additional things going on there. PE firms, as we all know, use leverage to finance their acquisitions, and that in and of itself allows PE firms to buy businesses with a combination of equity and debt that some other buyers may not be able to, do, attributing or contributing to how and why PE firms can pay more. PE firms also know that they'll be able to employ post-transaction financial engineering strategies to enhance the value of the businesses they acquired. And so, and I'm talking about things like restructuring debt, bringing teams in to improve operational efficiency, cost-saving measures, all that kind of stuff. So they can, so a company, a particular target, can be more valuable in the hands of a PE buyer than in the hands of another buyer sometimes. And the other way, looking at sort of the other side of your question, PE firms typically have a fairly short, finite investment time horizon, and leaving aside the fact that family offices are coming in with longer time horizons, although that also brings to bear more competition, but that's a different story. The fact that they do have finite investment horizons means that the minute a PE fund buys a company, usually that means within 8 to 10 years, that company's gonna be on the market again.
You took a second there, but then you ended up with an A+ answer. And I think also part of it has just been the last several years, private equity with the low interest rates that came out of the Great Recession just a really favored asset class. It's mostly the limited partners are like pension funds and university and investing, and it's just gone up, up, up. And we may be right now in 2024 kind of at a pivot point. M&A activity is really slowed down right now because there's not necessarily a meeting of the minds. 21 was like a record year, and now it's slowed down as the Federal Reserve raised interest rates. And it's kind of a question of where it's going to land, if it's still going to be such a favorite. It's been a great investment for everybody, and if that's going to continue or start to be more maybe realistic. When we started, a lot of us on this call, our career companies would sell typically for 3 to 5 times multiple, and now they're selling for 8 to 12 time multiple. So, are the companies really worth that much more, or has there been kind of a valuation inflation?
Yeah, Tom, and also when you're talking about the private equity buyer, the private equity universe is changing pretty significantly as well for the times. And you're seeing more and more firms not just be a financial buyer, but they're also adding layers of operational expertise and industry experts in the niches that they participate in, so that they are truly becoming more of a strategic buyer. And they're looking at, not just financial engineering, but an effective acquisition strategy or roll-up strategy, getting into tangent and synergistic products and services to kind of grow these companies, because they can no longer just rely on the financial engineering to garner the returns that they used to have. And because there's
go ahead, finish up.
Because there's so much dry powder, I think these private equity firms are looking at fewer opportunities. They have to make themselves more relevant. Otherwise, they'll lose that opportunity, invest that cash, and gain that management fee. So it's going to be interesting to watch over the next, say 24 to 36 months or so.
I have to, and with that answer, Greg, you've earned the next question. This one is one of my favorites because we get it all the time from sellers. Is why do they need to hire an intermediary, and how much does the purchase price of the company play into that decision? But let's just talk about why to hire. And so many times you go to a company and they're like, I think I know who the buyer is. I don't see the value of bringing somebody in. I'll work with my attorney. I'll just, so give a couple.
Well, you actually said it best, Tom, and you said it on this call today. The next buyer usually will pay $1 more than the previous. And so if you only have one buyer, you have a risk of a longer process because they know they're the only buyer. And the diligence process is very, very significant today as the cost of capital has increased. But I always say that, a solid investment banker, and that's the world that you and I kind of play in, but even a business broker and an intermediary, et cetera. The task is to find the best value for the client, the best fit for the client. And then I always also say the best future for the next generation of XYZ Corporation. And in order to do that, you have to go broader than just reaching out to one or two. Ultimately, a lot of our clients, being part of a top 20 CPA firm, they get approached to be acquired. A lot of times that value, they'll ask our opinion, does that make sense? Sometimes in the rare instance, it does make sense. It seems like it's a very stretch fit. Let's move forward and let's see if they can put their best foot forward and move efficiently. A lot of times it's a lower offer or it's a very structured offer, and you don't really know what the other options are in the marketplace. And a quality investment banker will help you look at, when going and strategizing for going to market, you'll be looking at all the different opportunities, and you never really know who that best fit is and the best value until you're in market. And I can say, and on one quick comment, we have one client that's in market right now. They had always thought, hey, the valuation of this company is going to be $30 million. We signed a letter of intent over $50 million.
Well, congratulations.
So the market is, is what, that buyer sees in terms of where that growth can go. And sometimes that growth can go somewhere that the owner of the company may not fully understand until they start talking to folks.
Well, and I think, and we're going to get to a selling process is a major event, and it's like a water going. It just gets more and more, and that can be distracting to running a business.
Yes.
It's good also that you're going to often, as a seller, end up working with the buyer. It's good to have an intermediary that can be that tough cop. And there's going to be breaking points. So it's like you wouldn't probably want to go to Vegas and play in a high stakes poker game than you've never played before. It's nice to have somebody that's played the game. But on the other side, Phil, I'm going to ask you this one: are there any pitfalls to consider when working with incentive-based professional? I frankly can't think of any, but no.
Either can I.
Well,
You're not biased at all.
No, not biased.
With all due respect to both of you, and I don't really mention these as pitfalls. I mention them as areas that need to be addressed so there aren't pitfalls. And quite frankly, one of the things is there could be higher fees associated with it, but in the offset of that is there's generally a higher price. So the seller gets more value. So you really shouldn't be concerned that there may be a higher fee if you're getting more value, right? So I don't really see that as a pitfall. The other is if you're continuously looking for a perfect broker, then you're going to be disappointed because, quite frankly, you've got to find the best person that's best qualified to sell the business. And Tom, I think you mentioned this a minute ago. Each business is unique. Mm-hmm. And what you've got to have is somebody that is assisting you that understands the industry that your company is in. And if you get somebody that doesn't understand the industry, I think that is a pitfall because I think that could leave things on the table. So I think that's important. You could have some conflicting interest if the professional is trying to maximize the price and doesn't look at what the success ratio is or the success possibilities are, what the culture is of the companies and whether or not it's going to fit. You've got to take all of that in consideration. But in my experience, all of the professionals that I've dealt with in that capacity have always taken that into consideration. So again, I don't see it as a pitfall. I see it as a potential problem if it's not addressed. And then the last one that I would mention, and this is where I see it break down a lot, when people don't go through and make sure that the engagement reflects what the parties intend. And that's when you've got a seller that may not be as sophisticated as some others are, and they may not have thought through everything. You get to the end of the transaction and you start calculating the percentage of the fee, and all of a sudden the seller says, well, that shouldn't have been included. Well, clearly, if you look at the engagement letter, it was, and it's kind of late to be asking that 2 days before closing. And so I think it's really important for the parties to understand what the engagement is and what the fees are on the front end and what it entails in order to avoid those pitfalls.
Yeah, I agree wholeheartedly, in that regard.
If I can,
you mentioned, go ahead.
Oh, I was listening hard, but I didn't hear. Phil, did you address the sort of the potential for seriously misaligned incentives? I mean, when I buy a car, I know that the guy that's trying to sell me the car is going to earn a commission. It's the same thing.
I touched on it. I didn't get into it in detail. That's really what I meant with conflicting interest, because quite frankly, if who are you representing? You got to be clear on that in the engagement. You got to be clear what the scope of the engagement is. And that's, I think, Jonathan, how you avoid some of those conflicts. But it's really important for the parties to understand what the engagement is, what the roles are, and what the intended outcome is going to be. Because that's where you run into conflicting interest if you don't do that, in my mind.
I see actually less chance when I'm selling a company. I want to make sure I'm aligned with the client, make sure sometimes they don't want the highest price. They want to make sure their employees are continuing. You got to make sure you understand. But I see less conflict than sometimes when people are on the buy side, or like if I'm doing a debt advisory where I'm bringing in a loan. On the sales side, they often want the highest price. If you're on the buy side, I think often you could be at a conflict if you were trying to get paid a percentage on what the price is, sort of like selling a house. You know, I like to be aligned with the client, and also sometimes maybe even give incentives. If this amount is a normal amount, we'll make this fee. But if we can do something extraordinary for you, we could get, you know, align what they're really looking for.
Well, I was talking about, and I'm not suggesting most intermediaries, whether they're business brokers or investment bankers, that this would be true of most. It's the exception, but you have to be aware that some small percentage of not great members of the profession might prioritize, you know, a lower price that's all cash as opposed to something that might be harder to close and that maybe doesn't that includes you know, compensation that comes later, right? I mean,
That's a good
And I
point.
think,
I
Jonathan,
think
you address that by having a full deal team. So it's not just the investment banker, it's their counsel, their attorney, their accountant, and their other advisors. So collectively, you have a deal team to kind of keep that, find that, you know, what I said, the best value, the best fit, and the best future for the company. But Tom also mentioned the other thing, the importance of an intermediary professional is to keep that business functioning and focusing on running their business and keep the process from intruding on that business. We are entering a phase where diligence is more thorough. And if you don't have a champion to move the process along, once you've identified that fit, that process is going to linger and it can become a very major distractor to the performance of the company.
I'm just going to say that I think incentive base is less pitfalls than when people work on hourly fee, which I see some small business brokers or consultants do. And then they don't have an incentive to get the highest price. They have an incentive to bill the most hours. So I think sometimes I see that where I talk to a consultant and they'll say, well, I'm just milking it at this point. I think incentive base really aligns you. And I like to take a risk myself on it so that we're all in the same boat. I'm going to move to the next question.
Before
Go
you,
ahead.
let me just add one thing.
Yep.
The one mitigation strategy that we didn't explicitly state that absolutely vitiates my concern about the, you know, the dishonest or unethical player is how the intermediary is selected. If there's one takeaway that I hope everyone, you know, watching this webinar will go forward with is you don't hire the guy that cold calls you. You hire people based on, you know, professionals based on recommendations from people you trust.
Yeah, and Tom, one last thing. I think all three of y'all mentioned this. Everybody mentioned it, and this is really the important concept too. You've got a team of people representing that seller, and there's some checks and balances there. And generally speaking, that team has worked together in some capacity somewhere along the lines, and there's a safeguard there. And the problem runs into, like Jonathan says, all of a sudden you end up with a group of people you've never dealt with before, they've never worked with each other before, and maybe the checks and balances aren't as good as they should be. But I do think it's important to have that team in place, and I think Greg mentioned that and you did too, that really represents the seller's interest and make sure the right decisions are made.
Good point. I'm going to move to I'll take professional intermediaries more about finding buyers or investors, power of the Rolodex. Are they more about advising and documenting? And I think they're really I think a lot of times there's too much emphasis put on that a intermediary knows a particular buyer. It may be that they favor them. I find that really the key is how you run the process, how you put the materials, how you present the company, how you make sure you reach out and get everybody into the process. I find that generally, if you've got a good, you know, and you're working hard on a process, you're going to find those right buyers, but you got to make sure that they I look about like bait on a hook to fish, you know, you got to make sure that they see it and that they get a chance to get into that process. Because like I said before, the price ends up $1 more than the second highest bidder. So you want to make sure you got everybody that's serious about that. And they may be different. Maybe somebody's a German company and sees the chance of getting in the United States. Another person just likes the sales methodology. You don't know, but you want everybody to be kind of teed up and competing.
And the goal with that, though, Tom, as you mentioned, is the more buyers that have an interest, that submit an indication of interest, submit an LOI, gives the seller more opportunities to choose, so they can find that best fit and the best future for the remaining employees and things of that nature for the firm going forward. So if we do our job right, there should be, a selection process. And I always like to say, it's a real life valuation process that you're going through. And it's, you'll learn a lot about your business, because there's going to be a lot of smart people asking a lot of questions that some you may not have thought about.
Jonathan, next question for you. For things like capital expenditures, does infrastructure investment make sense leading into a sale?
Maybe. Look, when selling the house you live in is on your mind, when you think, you're going to be selling in the next 6 months, 12 months, whatever, does it make sense to add a bathroom? What about a swimming pool? Leaving aside the personal enjoyment that, you can't really quantify, that you and your family will derive from those things. You could look at statistics to see what's spending $1 on average, what's spending $1 on a particular type of home improvement is likely to yield an added or even reduced sale price. Not everybody views a swimming pool as a good thing. They view it as a hole in the wall and a hole in the ground with a liability. So the question of CapEx spending in the corporate context is not that different. Upgrading, expanding infrastructure can obviously enhance the value proposition for the business, making it more attractive to potential buyers. Things like, and we talked about in an earlier question, I think Phil addressed, you asked him, what are some things management can do to increase the value of a business as it prepares to approach outside parties? And we talked about some of those things. If your supply chain is entirely in China, that might have sounded like a really good idea, 10 years ago. But maybe you need some redundancy there that's domestic. Investing in technology and processes that boost productivity, increasing quality control. I mean, the list goes on in terms of the types of things a leadership team can decide to spend money on. And it's a, item by item analysis.
It's a great answer, John. And I think buyers want flexibility. So if they're coming into they don't want to be tied into a building, for instance, that maybe they're going to want to get out of. On the other hand, they want to make sure they're not going to get kicked out of it. So it is a balancing act. Great answer. I'm going to go through the next question now to Phil. Walk us through the types of purchase price consideration available to a seller.
Yeah, and I think that's on slide 13, Tom.
I got it right there.
Yeah. The first is the easiest one. Obviously, if it's an all-cash deal and you're the seller, really you just need to be concerned with the agreement, which is the topic of a future seminar or webinar. The next is a seller note. That's where you really need to be concerned with what the financing is, what the terms are, what the collateral is, how the business is going to be run, and it's certainly more structured. Of similar concern would be an earnout situation where you may get a higher price, but it's based on earnouts. And how are you going to control the future performance, and how are you going to regulate it and monitor it? And so there are complications there. Again, when you're selling a company and you're selling it for cash, the due diligence is really this, in my opinion. You make sure the buyer has cash, and that's really all you have to do. If you're taking stock in their company as part of the transaction, then again, you've got to look at whether or not they're a viable company, whether or not they really have a good earnings history, what's their future, and do your due diligence from a financial standpoint. And one that's not up here that I see sometimes is where, as part of the process, you'll have an equity rollover. I may sell 80% of the business and keep 20% based on future value, where you're continuing as a shareholder. So you do have concerns about the future performance of the company. And each one of them has a variety of steps that probably exceed our time today.
Yeah, that's right.
But certainly that would be the most common forms of payment, with some varying risk associated with each.
Yeah, one comment I would say, when you say all cash, and this, sometimes confuses some sellers, all cash is a cash payment, but, in the significant majority of deals, there is always some sort of escrow provision for reps and warranties that we'll talk about later, or a holdback. So there may be some cash that's deposited into a third-party account that will be released at a later date, even though it's an all cash transaction. And then I also will say that, we do focus a lot on the strategic buyers, and sometimes they are publicly traded companies and they will issue restricted shares. And that is a good option sometimes, even if the restriction on trading those shares may be a year or 2 years. It may be a good risk and a form of consideration for our sellers to consider.
I think one other thing when we were talking about making sure it's clear up front with your intermediary is another form of proceeds is assumption of debt. And sometimes that's not clear. So for instance, the company has a $5 million working capital loan with a commercial bank, and the buyer assumes that loan is part of the purchase price. That's considered, proceeds. And that sometimes maybe isn't clear. So it's very important in the contract that that's specified, so there's no disputes later.
Yeah, and Tom, for our purposes, most of the transactions we see are cash-free, debt-free. But if they are assuming that debt, or even sometimes that lease that's not an operating lease, that is consideration to the seller.
It gets complicated here with like working capital consideration. And I'm not sure if we're gonna, but if they buy that and then they assume payables, for instance, and maybe there's an adjustment. Is that proceeds or not? These are things that really need to be clear, so there's no disputes.
Well, and when you're talking about assumption of debt, you've also got to remember that in a lot of instances, you might have a personal guarantee associated with assumption of debt. And if you're not getting a release of that, you really have a double dip at that point in time.
Right. Or even proceeds could be, let's say the owner signs, he's been making $250 a year, and that's president, and that seems like a fair amount. But then he signs a contract for $2 million a year with the buyer. The excess amount is proceeds.
Well, and let me just, this will be my last word, I promise you. But both of y'all kind of touched on it. But let me give you a worst case scenario. You sell it for all cash. You've got indemnifications or holdbacks that all end up being triggered. And there was debt associated with the company that you didn't get your guarantee out of. All of a sudden, all the money you thought you received is going back to the buyer, either through payment of debt that you've got to try to collect as a guarantor, and through indemnification. So it's really important. But that gets to, I think, a later series when we're talking about documenting the transaction more than it is the general concepts.
Yeah.
And you need a good team. So not
Absolutely.
only a team prospecting and finding new solutions, a team making sure the legal documentation, all the T's are crossed, the I's are dotted, and you're not leaving a personal guarantee behind, because that would be terrible. We don't, we always ask that, but a good counsel should be on top of that.
If I can overlay, the two bankers, iBankers on the phone, stated as unequivocal declarative statements that certain types of value given, like the example of a $2 million salary when his start was 10% of that it sale consideration that that a commission or should be earned on. That's generally right, but like all other things in law and life, it's negotiable.
Yes. That's why I said you now got to be clear up front in the contract, kind of getting back to original point, because you're right, it's debatable.
Yeah, what is considered excess, and you usually see that in the contract. But a lot of these are typical in terms of assumed debt and excess compensation, et cetera. But it is negotiable, and that's why it's important to have an attorney review. And we're required as broker dealers to have an attorney, the client have an attorney to review, or at least tell them they should review our agreement.
Jonathan, I'm going to ask you if you have any tips for running your business while active in the sale process.
Sure. So we've uttered the words, a dedicated team, a dedicated team to run point on the transaction, to oversee it, is important so that other people can focus on day-to-day operations. Because if you don't do that, then the thing that you're selling isn't so good anymore. As a realistic matter, though, for smaller businesses, designating a team is sometimes easier said than done. Often, one person is what's the expression, the chief cook and bottle washer. And that dovetails right back into some of the value proposition of why professional advisors are a good thing. They can help solve the bandwidth issue. Presumably, we come to the table with lots of experience and knowledge and contacts and stuff that the owner and management team doesn't have. But we also, when we're doing something, that was one less thing that owner and management has to do. And presumably we can do it a lot more efficiently because it's what we do. That's probably the big one. Really quickly, the other stuff that comes to mind is figure out how you're going to communicate the potential sale transition of the business with employees, balancing the desire to be as transparent as possible, generally, with the need for confidentiality, not to make people unnecessarily scared, that type of thing, on the other hand. And so each situation is going to be different. And then more broadly, beyond the employees, maintaining confidentiality as and for as long as you as owner and management deem appropriate, because again, some customers may really be concerned, and so there's a timing and there's a time and a place and a way to communicate something as big as, oh, by the way, ownership's is going to change.
That's a great point, and I think we see different between people that tell the whole company and others, like basically they get mad if you sign the guest register. And I generally find it ultimately everybody's going to know this is a big event, and you want people to be communicated to the right way. You don't want to find out through the rumor mill, and you want to present what's happening. People have lots of fears of M&A from Hollywood and everything, that everybody comes in and they're going to just like tear everything down. And in fact, normally it's the opposite, is that people buying the company are looking to grow it and invest in it.
I agree.
And one last thing on this question, Jonathan, is while running during the sale, are there like kind of ordinary course concerns? Like, you're selling, generally there's provisions after you get through the letter of intent that how what type of things you can materially, do. So you don't want to necessarily like, fire certain people or buy a whole new building. I mean, that's going to like kind of affect your sale process.
Yeah, I mean, you asked and mostly answered your own question. That's right. There's usually, as in like always, a contractual provision that says the business will continue to be run in the ordinary course. And then as a practical matter, until the buyer is absolutely bound, while due diligence is going on, if changes start to get made that the buyer is not happy with, that can, derail a deal.
I'm going to ask the next question goes to Richard. What are pro forma adjustments, and when do you see them as most successful in increasing the value of a company?
Pro forma adjustments are entries or adjustments we want to make to the financial statements for, a lot of times it's personal expenses that we're running through the company, or anything that's not operational for the company. So what we want to say is my financial statements indicate one set of numbers, but you know what? In reality, it's really something different. And so now how do we prove that? So we want to go through and look and see what sort of adjustments need to be made, be able to support them, and go back for X number of years and quote, fix that sort of thing so that the potential buyer understands what is actually going on and why we are claiming that our profitability is a lot lower than what we're indicating it probably should be. So it's just making those adjustments, identifying what those are, getting those recorded. And what I try to do is get the world that I live in, we do a lot of litigation and is how do you prove it? So we ask for information that will indicate that this is what I'm doing. And it can be a time consuming process, but really what you're trying to do is identify some of the skeletons that you still have hidden that you haven't disclosed yet, but you want to be compensated for those.
You know, Richard, it seemed like this used to be a much simpler question, and it was kind of obvious things like an owner had his car that he only used personally was in there, or his wife was on the payroll, didn't work for them, or there was a major flood or lawsuit that's a one-time event. But it seems like now. Can you talk to how there's just a lot more potential adjustments, and then also talk about how COVID plays into this?
There seems to be a lot more adjustments. We have checklists that we go through that kind of jog our memory on different things that are there. We probably have close to 45 or 50 different items. One of the things I see is very common is I'm sending my kid to college. So we're paying for all the college tuition. Oh, by the way, my kid needs a car. So running all this sort of business through there. I want to make some repairs to my house. So we're just going to have the contractor be paid through the company. And people are just doing that more and more. I think that when you have these closely held companies, the attitude is, well, this is my piggy bank. I can spend my money like I want to spend my money. That's not necessarily fine. The Internal Revenue Service doesn't appreciate the humor in that. But then we have to then we have to try to prove that this was all wrong, which in my opinion can pose a lot of different problems with your tax returns that you have filed. So and then it's just a matter of you'd mentioned COVID. I think we're actually seeing a little bit more of that because times got tough and my compensation has gone down. I'm not able to get the quote, the money out of my business that I was looking for. So in order to survive, I'm actually taking more money out of the company through i.e. benefits versus a W-2 or some sort of compensation that's out there. So we're seeing that a little bit more and more right now, and it's still lingering.
Yeah, and our goal, Tom, when we kind of look at this is, are we normalizing the financials for the new buyer? So we're taking out all those extraordinary expenses. We're normalizing what the business needs. And, you know, they get less aggressive typically as the company gets larger and there's more of a management team. But it is an exercise and it is going to be looked at very, very closely post, in diligence.
Well, this has been fascinating and just a really fun conversation and educational. So this is going to end part one, and it's going to be, I'm going to leave on a cliffhanger here because now we're going to get into really the nitty gritty of like really getting a deal closed and the considerations. It's going to be fairly advanced and looking forward to having this talk next week for part two. So those that have joined us so far, we look forward to seeing you again, and thank you. Great job, all of the panelists. And that's going to be a wrap.
Okay, thank you very much.
Thank you.
Appreciate it.
Thank you.